Hello everybody, Luke Gromen, FFTT. Hope you are well and having a great week. Gonna jump right into the questions this week. Thank you as always for submitting them. Really enjoy these conversations. So let's jump right in. The first question is from N. Your call for no recession reminds me of 2001 when the dot-com bubble was deflating. The risk of recession then was low as the economy was very strong. Then 9/11 came to hasten global fund outflow. What are the chances of something similar happening? I think very, very low. In 2001, the U.S. was running a surplus at the fiscal level. Means the United States government was actually withdrawing money, basically, from the private sector on net. Warren Mosler was warning at the time that a recession was a mathematical certainty, basically. Mosler is now pointing out that a recession is extraordinarily unlikely with an 8% of GDP fiscal deficit and rising. Now, with that said, I do agree there is some outflow risk. If China repatriates capital out of the U.S., that drives stocks down, it drives yields up, and then in theory you could see a recession. But again, only if that forces the United States government to shrink its size or allows the Treasury market to dysfunction. In other words, 10-year goes to 5, stand aside. 10-year goes to 6 the next week, stand aside. 10-year goes to 7, stand aside. And that would be caused by interest expense essentially crowding out global dollar markets. Dollar up, rates up, stocks down, receipts down, deficit up, rates up, dollar up, stocks down, until receipts fall below interest alone and the United States government says, oh, we don't have enough receipts to pay interest, and you know what, we're not going to print the money. We're just not going to pay Treasury holders. Then that's a default. And then when you default on your Treasuries, that creates hyperinflation. So now, to be clear, that isn't going to happen. I think there is zero chance of that happening. So if they allowed that to happen, then yes, you'd get the mother of all recessions, but only for a moment, like I said, because then one or another of things going to happen. They're either going to print the money to pay the interest, and as a practical matter, I think the real number is not just interest, it's interest plus entitlement pay goes, and we're already at 100% of receipts on that number right now. So they need to make that decision, print to pay it or start defaulting on it right now. Or if you ultimately take it all the way and you default on treasuries because you don't have enough receipts to pay the interest, then when the currency's backed by the debt and the debt defaults, the currency goes to zero. You have hyperinflation. So that's not going to happen. And if that happens, you're going to have GDP to the moon on a real basis, by the way. There'll be no recession in that case at all on a nominal basis. Now, on a real basis, yeah, it would be the worst recession of all times. But the stock market would be at a gazillion dollars, and it would buy you like 3 eggs. So, again, don't think that's going to happen, but I use these extremes to inform the means, which is to say it is apples and oranges to 2001. Someone kind of highlights a 2001 case to you, crinkle it up, throw it in the trash. Completely different now. From B, at what level does the marginal return product of debt and fiscal spending become small enough or turn negative that it no longer solves any issues or actually starts being counterproductive? In my opinion, this too is an important question. It's one that Lacey Hunt and a lot of others highlight, but they frame it on a first principles basis, assuming that the real value of treasuries must be and will always be maintained. I understand that because Lacey runs a long-term treasury fund, primarily. However, in my opinion, I think we are already past the point of marginal return product of debt, fiscal spending, etc. And in theory, that points to a deflationary outcome. I get it. I get that's what the textbooks, the academic textbooks are telling us. However, that ignores political economy and it ignores realpolitik. What do I mean by that? Once we get past that point of diminishing marginal return, product of debt, etc., the choices are very straightforward. Shrink the government on a nominal basis, which means cut government spending, which practically speaking means cut, if you can't cut interest rates, right? That's reinflating. There's only two other things to cut: entitlements and defense. That's choice one. Slash entitlements, slash defense. The other option is shrink on a real basis, which is to say nominal GDP keeps growing up, real GDP falls, real rates are negative, and long-term treasuries lose to everything else. The latter has been chosen. We can see it. Call up a chart of the S&P 500 over TLT, the long-term U.S. Treasury ETF, up and to the right. And it's accelerating up and to the right. Gold over TLT, accelerating up and to the right. Bitcoin over TLT on high volatility, accelerating up and to the right. Houses, accelerating up and to the right. And ultimately, that has to be chosen because that's the only way to sustain the debt. So I understand the academic discussion around marginal return, product of debt, etc. when it runs into realpolitik of, hey, if we want to maintain the real value of treasuries, we need to slash defense and entitlements by 30 to 40% immediately and permanently. Guess which discussion wins? The guys with the haircuts like mine with big guns and the 70 million boomers who want their entitlements win the discussion, and the real value of treasuries loses. That's how it's gone for 1,000 years of human history, with a few exceptions at most. When you can print the money, when you owe the debt in your own currency and you can print the currency, you don't cut government spending to maintain the real value of the debt. Almost nobody has ever done that. It's not different this time. From Tobias, in your opinion, is the 10-year U.S. Treasury yield moving back up above 4% a sign of a bond market revolt or just short-term noise, i.e. profit taking after everybody was just front-running the Fed? It did the exact same thing in 2007, moved up while the Fed was cutting. Ultimately, yields on the 10-year Treasury went much lower. I think it was a tremor of some in the bond market beginning to recognize that the Fed is cutting rates to help the U.S. fiscal situation. Just like 2001, 2007 is apples and oranges to where we are today. Very, very different. In 2007, U.S. debt to GDP, much lower. Deficit to GDP, much lower. U.S. net international investment position was only negative 15% or so. It's negative 80% of GDP now. Foreign dollar denominated debt was much lower in 2007. I want to say it was 4 or 5 trillion. It's 13 trillion now because the Fed kept rates at zero and turned the dollar into a global funding currency. But let's talk through 07 to understand why it's so different and why 10-year treasuries have to be certificates of confiscation on a real basis. Let's talk through it. In the great financial crisis, following that 07 period, federal receipts fell 28% year over year. In 2001, they fell 19% year over year. So let's take federal receipts down 19 to 28%. True interest expense, entitlements plus interest, is already at 100% year to date of receipts. In August, it was 150% of receipts. In July, it was 120% of receipts. So, a recession is going to spike the dollar as U.S. deficits blow out. You're going to have receipts down. Let's just split the difference. We'll take the lower case. Let's take them down 20%. Your true interest expense is now 120% of receipts. Uh-oh. Because a lot of that's the receipt, the interest portion, a lot of it's priced in already. Like, you would have to slash rates to zero tomorrow and you're still going to have like $1 trillion interest expense. It takes a while for that to reprice. So, U.S. deficits are going to crowd out global dollar markets. The dollar is going to spike. But now foreigners, unlike 07, unlike 01, are net short $13 trillion in dollar-denominated debt. They need to pay it back in dollars. They have plenty of dollars. Unlike 2007, when the net international investment position was negative 15% of GDP, and unlike 2001, when the net international investment position was negative 3 to 5% of GDP, it's now negative 80% of GDP. Foreigners own $22 trillion net, $57 trillion gross in dollar-denominated assets. And they will sell every last one of those to pay their dollar debts. Okay, they're going to start with treasuries. They own $8 trillion in treasuries. And so rates are going to maybe stay flat in a recession. They'll probably go up at the long end. Now, that's going to send rates up in a recession. Receipts are going to go lower non-linearly. Non-linear receipts go lower. Deficits go up non-linear. Issuance goes up non-linear. Dollar goes up non-linear. Foreigners sell more treasuries to defend their currency and pay their dollar debts non-linear. Wash, rinse, repeat. Until either, again, interest alone is below receipts, and then the Fed says, oh, we're still not going to do anything about it. We're just going to default on treasuries. That ain't ever going to happen. Or the Fed balance sheet at some point, and it's not going to take long, grows by an amount that makes COVID's $600 billion a week QE look tame. Or, per the prior point, the U.S. cuts entitlement spending and defense spending by 30, 40% or more immediately and permanently. We pack up all our boys and girls overseas. We bring them home. We cede Eurasia to China and Russia. We tell the boomers, spend your own money. We're done. In front of an election. And then we get an actual honest-to-goodness depression with a capital D in terms of what happens to nominal GDP. And we probably, in short order, get some sort of political, I don't want to say the word because then YouTube will stop monitoring, won't even publish this, but you'll get a political populism episode that makes what's his name from a couple years ago look tame by comparison. So, 2007, apples and oranges. 2001, apples and oranges. 10-year treasuries at the long end, they must be made certificates of confiscation on a real basis to keep the debt sustainable on a nominal basis. Full stop, end of story. All right. We're dealing today. We're fired up. All right, next question from Stu. S&P 500 at the highs, VIX volatility 21, which is still relatively low. Explain, please. The Fed and Treasury instituted a U.S. Treasury volatility cap in September 2019 when they stepped in to stop the repo rate spike. If we all wanted free markets, we should have just let repo stay at 8 to 10% in September 2019, let mortgages all reprice at 11, let T-bills reprice at 11, let that crowd out defense, entitlement, blah, blah, blah. But nobody wanted free markets, right? There's no atheists in foxholes, are there? Same thing here. March 2020, volatility cap on the Treasury market again when off-the-run Treasury market started crashing at the lows in the COVID crisis. Fed stepped in with massive QE to make sure the Treasury market functioned. Their words, not mine. 3Q22, Treasury ran down TGA aggressively to weaken the dollar. Dollar went from 114 in September or October 2022 down by about at an annualized rate of almost 30% over the next 3 to 4 months. 1Q23, again, Treasury volatility spiked around the banking issues. They weren't really banking issues, they were Treasury market issues. Fed stepped in with BTFP, Bank Term Funding Program, I think, or as some called it, buy the effing paper. They started re-expanding their balance sheet. U.S. Treasury market volatility cap. 3Q23, Fed and Treasury. Fed jawbone, Treasury shifted issuance to the front end. Voila, dollar down. Treasury volatility down. Treasury volatility cap. The release valve to this cap has been, as we have seen, S&P up, especially relative to TLT. Gold up, especially relative to TLT. Homes up, especially relative to TLT. Bitcoin up, especially relative to TLT. The way they've allowed the system, policymakers broadly, have allowed the system to evolve requires that those all go up and to the right. All those charts relative to treasuries go up and to the right over time, increasingly nonlinearly. I didn't make the rules. I just play by the market that's been given to me. And that's the only way to sustain the debt once it's over 110, 120% debt to GDP. So here we are. And that's how you get S&P at the highs and VIX at the lows, and why I think you'll, with brief episodes, continue to get that. And finally, from Wade, can you comment on MicroStrategy's Bitcoin strategy? Yeah, I think ultimately, and a useful analog, it's not a perfect one, but I think it's useful. It's the Hunt brothers on silver. Except Bitcoin is higher stock to flow than silver. And there's no unallocated Bitcoin derivatives on the horizon centered in London. And COMEX probably can't change the rules to sell only on Bitcoin like they did for silver. All they can really do, in my opinion, in the intermediate to long term, is bleed out government-owned Bitcoin over time at key technical levels to try to contain. Do I think that's happening? I don't know. I don't know. We know the government has sold a little bit, but I don't know whether that's happening or not. I'm simply saying that is something that in theory they could do. But that's how I'm thinking about it, is MicroStrategy's Bitcoin strategy. It's a Hunt Brothers type strategy, except with a much hard asset and a much harder hard asset to prevent a short squeeze. So I'll stop there. As always, if you like these updates, check out FFTT-LLC.com for more information about what we're up to and our Tree Rings product, 10 most interesting things. Brief synopsis on what grabbed our attention about each of them, how it's changing or confirming a way we'd previously been thinking about the world. And I'm going to sign off for now. Everybody have a great rest of your week. Stay safe out there. Glad to see the hurricane didn't hit Florida nearly as bad as we thought. Hope everybody gets the power and water, etc., turned back on as soon as possible. And everybody have a great rest of your week. Take care.